Hello everyone, I'd like to welcome you to the third week of the semester. I hope you find the topic we discussed over the last 2 weeks about partnership is interesting, and I hope you still remember the key points in partnership is how to start a partnership, how to accept a new partner, how to make profit distribution, how to withdraw from an existing partnership, and finally how to liquidate the partnership. But when we come to the liquidation of partnership, we find it very simple comparing the liquidation of a corporation. Because in partnership, what we usually do, we sell the non-cash assets and convert everything to cash, pay the creditor, and the balance, we give it to the partners. But when we come to corporation, here we can see the federal law is issuing 2 chapters for the liquidation. The first one is a Chapter 7 for liquidation, and then the next one, Chapter 11 for reorganization. There is other chapters in the federal law about the adjustment of debt, about farmers, adjustment of debt of an individual, but we are not going to discuss these chapters during our topic this time, but we might discuss them when you take the federal taxation. So remember here that to do the bankruptcy or the liquidation of a corporation, we have to become familiar with what the federal law is discussing in these 2 chapters, liquidation and reorganization. I'm going to take a snapshot from the presentation of this chapter, so I'm not going to discuss everything we have it, but we will take snapshots, which I put it in my current presentation. But in the course material, please take a time to read the whole presentation of the whole chapter. When we do the liquidation in corporation, we usually try to classify the creditors into secured creditors and unsecured creditors. And for the unsecured, we have priority claims and we have non-priority claims. So what we do, we convert everything into cash, then we start paying the secured claims first, then unsecured the priority claims, followed by the unsecured non-priority claims, and finally whatever is left over we give it to the shareholders. And here I take an easy example which is presented in the textbook about CAM Corporation, and I need you to focus here on the estimated realizable value available for unsecured creditors, because usually what we do, we start to create the fair market value of the assets, credits, and the balance of the equity. So we take the book value on one side, as you can see it on the left side, the estimated realizable value on the right side, and then we start to calculate the difference. We do this for the assets, and as you can see it here, we go for the fixed assets and then the current assets, where we have the comparison between the book value and the fair market value. We do the same also for the creditors. As you can see, we classify them here by the fully secured creditors, down by the partially secured creditors, and finally the other accounts for unsecured creditors. And once we do the evaluation, usually the court is appointing the middleman, which we call him trustee. The trustee will do the normal evaluation during the case time. The trustee creates a new set of books during the case, like books for transactions, statement of cash receipts and payment, statement of changes in estate equity, balance sheet, and the statement of realization and liquidation. And here is the financial statement looks like. So you can see in the balance sheet, we make evaluation before the case and evaluation after the case. The one before the case, you can see it on the third column from the left. And then after the evaluation, we put the last column on the right. And then between them, we make the calculation for the re-evaluation. So for example, if you pick the inventory item, you see it before evaluation, it was 350. After evaluation, 375. So the re-evaluation amount is about 25. So it goes like this. If the after re-evaluation is higher, the difference would be positive, and vice versa. And then we do the same for the liability and the equity. One pre the evaluation and then post the evaluation, and then we start to calculate the difference. And once we make the evaluation in this way, we make the reorganization plan. For the reorganization plan, we make the pre-petition liability and equity, and then how we are going to discharge the debt. Take your time to go through these amounts, and if you have any question, please go to the textbook or contact me and we will be able to discuss it further. Once we make the evaluation, we start to record the new debt agreement and we make a journal entry for that. The entry reclassifies the pre-petition debt according to the reorganization plan. Then we start to adjust the shareholders' equity, so we create a new journal entry to adjust the old amounts of stockholder with the new amounts, and the difference will go to paid-in capital. And then we reevaluate the assets, where we can put here the book value and the current value, and the difference between them is the loss on assets reevaluation. And we start calculate the balance in the retained earnings. And once we get the deficit, we start to allocate it to the capital. So here we make the reorganization value, and then we start to balance it off to create the final deficit amount. The 1,000 deficit on the date is adjusted for the gain on debt discharge and loss on asset evaluation. And once we finish this, we complete up the case, and then we distribute the balance to the shareholder. This is in a snapshot the topic that we are going to cover it in this chapter. Feel free to go through the material. I know it's more material than partnership. And if you need any help, feel free to contact me. Thank you so much, and hope to come back to you soon. Take care. Bye-bye.